Hello, Christian. It seems that equity markets have propelled higher based merely on the expectation that the Fed is going to cut rates, whereas other data points, whether it be long-term bond yields, job growth, or equity market valuations, suggest downside risk. My question for you is, in your view, can equity markets continue to push higher just on the expectation of Fed rate cuts?
I want to preface the answer by saying the crystal ball is foggy at best. But I think it helps to take a step back and look at the data, look at the facts. And as we sit here today, inflation has been above the Fed's 2% target for 53 months in a row. 53 months. And then you look at core inflation, and that's been quite persistently hovering around 3% for 2 years. And remember, over the past 40 years, the Fed cut rates a single time when core inflation was above 3%. Now, consistent with those inflation numbers, though somewhat moderating, when we look at wage growth, it's still trending above its 50-year average. And conversely, the unemployment rate is below its 50-year average. So what that tells me is this isn't exactly an economy that has a ton of slack. Meanwhile, you look at very long-dated treasuries, such as the 30-year, for example, and that's grinding higher. The yield is grinding higher, if anything. Then there's the Taylor rule, named after Stanford economist John Taylor. And when we look at the Taylor rule today, it would advocate for approximately 100 bips higher interest rates, not lower interest rates. So when you take all of that data in, the picture that emerges isn't exactly one that calls for significantly lower interest rates today. Maybe the risk of a reacceleration in inflation due to the tariff uncertainty, due to fiscal imbalances, maybe that risk of a reacceleration in inflation is actually somewhat balanced today with the threat of interest rates being restrictive to the economy. So in the global value team at First Eagle, we worry a lot top-down, but then we do invest our clients' assets bottom-up. And in that vein, it doesn't strike me as particularly prudent to bet on rising equity markets solely on the prospect of Fed rate cuts.
So let me follow up and ask you about that bottom-up nature. When you look at equity market dispersion in terms of valuation, there are some pockets of the market, like US large cap, which are definitely stretched relative to history, but others, like small cap and international names, which look more median. My question is, as a margin of safety-based investor, are you finding pockets of value to deploy?
So for bottom-up stock pickers like ourselves, this is actually a pretty interesting environment. If you look for historical analogs, the late 90s come to mind. So on the one hand, US markets are quite expensive relative to their own history. If you look at the S&P 500, it's trading in the 92nd to 98th percentile relative to its own history, depending on which metric you want to look at. Price to earnings, price to cash flow, EV/EBITDA. So a very expensive market. And when you then zoom into the data, what you will find is 10 companies in the S&P 500 make up about 40% of the index, and they trade at even higher multiples than what is already a very expensive index. Now, interestingly enough, with that kind of distribution, it also means there are pockets that are more neglected, where valuations are more attractive, and where we have an opportunity to deploy assets bottom up. The US healthcare sector comes to mind. That's an area we have been quite active recently. Then once you leave the US, as you mentioned, there's dispersion. So on an absolute basis, international markets are quite a bit cheaper than the US. But I think what's interesting is when you look at it on a relative basis, they are also trading a lot closer to the historical median, as opposed to north of the 90th percentile, what we're seeing in the US. And this is the case after international has already strongly outperformed year to date. So from that starting point, bottom up, we do find a lot of interesting opportunities to deploy capital in a wide variety of areas, such as, for example, Latin American and European consumer names, Japanese industrials, or Southeast Asian holding companies.
Well, thank you very much for your time today, Christian. I look forward to speaking to you next time.
Thank you.